that's the thing that came to mind for me, based on all the stuff that's going on. So I want to get to it, and this will probably be a little bit different than they'll definitely be different than the stuff that I typically do, just because of the things that are going on in the market. I really want to explain it to you, at least as I understand it, the best that I can do. And then at the end here, we will look at some charts. But I want to let you know this: there's so much uncertainty right now because of, the whole Silicon Valley thing and various others, that we really don't know. I would totally be wasting your time and mine if I'm telling you, hey, this is what you need to do on Monday. We just don't know. So I'll get to that um, right now. So this is really what I see. There's no such thing as one cockroach. You see one, but there's a bunch of others. And I'm also looking at canaries, and canaries in the coal mine, right? So this is the thing. This whole thing with Silicon Valley Investment Bank is, it's not the first canary. We've had others recently, which I'll get to in a second. But I want to, and you want to look at, when I'm looking at these canaries here, I'm telling you that we want to be aware of the current situation as it is. Look at the charts, focus on what you see, not what you hear, because you will see, whether it's Janet Yellen, nobody expects much of her. They never really have. She's a bureaucrat. You're going to hear everybody saying all is calm. Kevin Bacon's my favorite actor in the world, and he had it right in Animal House, right? You're going to hear people saying that, but they don't really know. Nobody really knows. And so this is the way I see it. Fred the Fed has been trying to kill inflation, and the Fed is what actually caused inflation. When you think about it started with, well, I won't get into all the details. There's a bunch of money pumped into the system because of COVID, even though it was actually put in late. It's really weird. It's like the problem was almost, well, it was kind of resolving itself, and then suddenly we decided we're going to inject all this money and give everybody free money, and the rest is history. I don't want to go back that far, because you should know all this, and if you don't, you need to get out more. But I want to just talk about where we are right now. So the Fed needed to take liquidity out of the system. They wanted to make money more expensive to borrow, and they actually did that. They kept raising the rates again and again and again. But what they wound up doing is they wound up kind of killing the lenders instead, at least in this case, Silicon Valley Bank. And so now we're kind of left with the aftermath. All right. I remember this. You hear people, and you watch people on TV, or you read these articles saying like, oh, this isn't like 2008. I was there in 2008, and it isn't like 2008 in that the cause of it is different. The consequence of it is different, but the psychology is the same. It's exactly the same. And that is, people feel uncertain about their money. Now, it's limited in scope a bit, but it's still kind of the same thing. I remember in 2007, which is actually kind of when it first started, there were mortgage-backed securities and CDOs, collateralized debt obligations. And these actually started because, thank you, Easy Al, because money was so cheap that the fixed income, you remember way back in the day when the idea of investment for your life, for your lifespan is, when you're younger, you can afford to take more risks. So you put most of it in equities. And then as you get older, you start to move more of your money into, quote, fixed income. In other words, into bonds. And the idea is that you've grown your portfolio, you've grown your liquidity, your account value to such an extent over the years that you have so much to put into bonds that you're able to live off the interest rates. And back then, I mean, it was kind of a different world. Rates could be 4, 5, 6%, 7%, even 8% on, say, 10-year treasuries, stuff like that. Even greater. People that are older than me remember that stuff more. I'm not even at retirement age still, so I just know it was a lot more. But so what happened when Alan Greenspan dropped the rates down so low in order to kind of quell the panic and the situation that started from the internet bubble, when he dropped them that low, what happens? Okay, the stock market crashed. Everybody saw what was going on with all these worthless companies that had a .com at the end of their name, but no way to make money. And so that crashed in, I think it started on March 14th, 2000, something like that, within days of that. And then, so rates are dropped way down, money's free. And so what do investors do? Hey, man, real estate looks good. Let me go get a loan. And so they started getting loans on real estate. And then that starts this big, massive real estate boom, right? Okay, so what happens to the old folks? What happens to the baby boomers who are starting to retire? Well, they can't invest more in bonds because they're getting nothing for their money. I mean, I remember griping about it many, many times, really, really loud, about how Greenspan and then later Bernanke, but that was a different story, absolutely wiped out an entire generation because they prevented people from enjoying their just desserts from all of their decades of saving. They could not get into bonds and be safe, so they had to stay in equities to continue to make money. There just wasn't any yield there. All right, well, in comes the mortgage-backed securities and collateralized debt obligations. They provided a higher yield for investors. And so fixed income traders and portfolio managers were loving it. They're saying, well, hey, I'll take these high-rated bonds because they're safe. I'm being told they're safe by Moody's. And I forget what the other rating company is. There's a few of them out there, but I'm being told that they're safe. And so now they can get their clients into these bonds. What they didn't know, and if you've seen The Big Short, you should understand this. It's definitely a movie that you want to watch several times because it's all true. Anyway, so what happens is these fund managers, they are putting together these collateralized debt obligations, these mortgage-backed securities, the mortgage-backed securities that they piled all of these different mortgage loans into. Some of them were super, super risky. They're ninja loans, no income, no job, no assets. Sure, buy a house, want to buy two. And so they put those in with the real high quality mortgages as well. And then because there's a blend, because they're diversified, they're able to give them a high rating. And so these things were just nuclear bombs waiting to go off. And then the CDOs were basically like massive bets on whether the bet of a different bettor, on whether a third bettor won on his bet that a fourth bettor would make money on his bet. Okay, they were like really stupid. Nobody understood it. Hey, but it had a high yield, so sure. Okay, I remember that back then. And it's kind of like the cascade had to start when there's some stripper in Florida that wasn't able to make the mortgage payment on her house. It started by somebody, and then gradually more and more people are defaulting. Lenders realize they have actually no collateral on these homes because they're pumped up higher than they should be simply because of demand. There was so much demand for these homes that the prices go up and up and up. And the lenders like Countrywide go, cool, we can make more and more loans, bring in more and more money. It's all good. Like it's literally partying like it's 1999. And so I remember going through subdivisions because I had a second job. Actually, I was really digging myself out of a hole as a general counsel for a real estate developer. And I remember going through empty subdivisions with like front yards that had weeds that were 3 feet high. It's like just a yard full of weeds. And seriously, with homeless people living in the homes, like they'd broken a window in the back and they're living in these homes. And so this, I remember thinking like, this is nuts. And then later we all know what happened. And it's kind of like that, that saying that, or that line from, and the sun also rises by Hemingway, when the guy's being asked how he went bankrupt, and he said, gradually at first, then all at once. And so that's what happened then. And it's the type of dynamic where, and this kind of brings us up to present day, where the lenders and the banks, venture capitalists, they're total capitalists during the good times. Hey, my risk, my reward. I take all the risk. I should reap all the rewards. That's capitalism at its finest. But then when there's a big crash, suddenly socialism sounds pretty good. And so they want to spread out the loss to everybody, which means ultimately you and I are going to wind up holding the, we're going to wind up holding the empty bucket of Silicon Valley. That will happen. Hopefully it'll even happen by tomorrow night. So anyway, that's kind of where we are right now. And this bank, this situation, the government needs to step in and do something. And it's really, truly got to be before Monday. And this is really what's happening. And you can read all this while I'm talking. Again, I'm just telling you, this is a little bit different. I've been doing a lot of reading, a lot of thinking, a lot of writing about this, because I feel like it's my job to make it more understandable for people. It's kind of like I do the work so you don't have to. So my job is to make it very clear to you. And I'm either going to succeed or I'm going to fail at this, but I'm definitely going to try my best. So this whole thing with Silicon Valley Bank is not really the first problem that we've seen. So there's the Silvergate debacle. What was that? A couple of weeks ago, Silvergate Capital, they're crypto focused. So that's different. Okay. That's crypto. And they said, hey, we took a big hit on FTX. And so because of the FTX fraud, we're done. Okay, so that was the one thing that you could say, but that's crypto. And then you've got the Silicon Valley lender, which is focused on technology startups. They don't loan money on real estate development. They loan money on startups. They loan money on ideas. They loan money on, think about it this way, the companies that are, or that are going to be in Cathie Wood's ARK Investment Innovation, ETF, and they invest in those companies. And I'm not saying anything bad or good about that. I'm just wanting to give you a vision of what these companies are. They're startups. They don't make any money, but man, they've got great ideas, and they're going to be the pioneers for technology over the next 10 years. These big technological developments that we have to, it's what we're working on today, where we will realize the benefits of that tomorrow, 10 years from now. So these are the types of companies that Silicon Valley Bank is investing in, at least their depositors are investing in. So they've got venture capitalists that have big accounts there. They invest in startups and they've got their accounts there. So you got all this money running through SVB, all this money running in there. And so then you think there's any bloat in there? think about the layoffs. I mean, Musk and Twitter it's kind of a different animal because I mean, that thing was a woke mess. It's been for years. I don't know how Dorsey got off the hook on that thing, but he seems to, like, hey, I didn't have anything to do with it. But Musk fired like 75% of the workforce. And then after a while, had to fire even more of them. I mean, these people were all just pushing buttons to censor people. And now, whether or not you agree with that, I couldn't care less, and you shouldn't either. I'm just talking about the money aspect of that. So there's bloat there, massive bloat. Why, by the way? Because money's cheap, money's free. How about Faceplant? Or now it's Meta. And how about Google, Goggles, whatever you want to call it? They're laying off. Why? Because as Zuckerberg said, and he's right, to become more efficient. I forget how many times he mentioned the word efficient in the last conference call. So that's a big deal right now. And that's a good thing. Okay, well, why are they worrying about being so efficient when they never have been before? It's like not a big deal. Well, the reason they're worrying about it, or they're dealing with it now, is because money is no longer free. And so they're having to cut back their costs. And this is happening it's probably happening with you. I know it's happening with us. We're kind of tightening our belts a little bit. I think it happens all up and down the food chain. And so then Silicon Valley Bank, they've got bad risk management, but they've got safe reserves. Okay. So this is what I'm talking about, safe reserves. Okay. They're holding a bunch of 10-year notes, treasuries. And by the way, there's a podcast, Jason Calacanis, and I'm going to stop recording because I want to give you the exact thing here of this podcast that you should definitely listen to at least twice. Yeah, it's called All In. And they have a really, really good podcast that explains this in more depth than I can explain it. These guys are venture capitalists. They got a boatload of money involved in all this stuff. And so they're very, very articulate. I have disagreements with Jason on various things. We're kind of on the opposite end of the spectrum, but man, I recognize insight and intellect when I see it. And this guy is a flipping brilliant genius, especially about this stuff. So this is how they explained it. And this is taken directly from their podcast. So you've got Silicon Valley Bank investing their assets in safe notes, safe treasuries. It's backed by the full faith and credit of the US government. They're going to get paid. And so let's say they've got $100 at 2% for a 10-year treasury. And at the end of that time, they got $122. My calc was 120, but I'm going with theirs. There's probably something else in there. But anyway, so it's $122 at 2% $100 note. Now, the same note at 5% is at $163. That would be better, right? So these guys have all of these notes that are yielding far below what the current market is right now, but it's okay. I mean, it's certainly not desirable, but that's banking. You got to keep your money safe. So the deal is, as long as they hold those notes, as long as they're not selling them, the value is, it's not mark to market. It's not what the current value is now. The value is they've got a return of 2%. That's it. And they're just seen as, they're not the kind of assets that have to be valued all the time. They're 2% notes for 10 years. That's it. However, when the company says, hey, we need to sell some of these, okay, well, they're not going to be able to sell them for $100. The value of that note drops by 25% in order to match the 5% rate. Because think about it. The owner has it at 2%, damn it. But somebody who's going to buy that note is going to say, well, I'm not going to buy it for a 2% yield. That's your problem, not mine. I need to buy it for 5% yield because that's what the market value is. They're going to pay less, so they get a greater yield on their money. So that's a 25% drop. And so when the Fed raised rates so fast, so far, so suddenly, that this 2% became 5% pretty quick. Like they were really raising them at a rate that would make Paul Volcker, blush. They were raising them at such a high rate that banks and investors haven't had a chance to really kind of catch up. And so it put a bank like this, which had a very poorly managed risk, management division. They didn't know what the hell they were doing. And probably most of them hadn't even been around when in 2008, 2007, certainly in 2000. I'm sure some of them have, but a lot of those people, they get their advanced degrees from these Ivy League schools, and it makes them over-degreed and underlearned. They have no experience whatsoever, but by God, they got a lot of good stuff hanging on their wall that impresses you and me. So the Fed raises rates so fast that this kind of thing happens. Now, as long as this is the only thing that's happening, it's still not a big deal because the bank just holds these notes until maturity. They would love to be getting the 5%, but they're in for 2. They don't want to take the loss, so they just sell them. Well, so so they just hold them. But the Fed doesn't do things with, these people are real freaking morons, to be honest with you. And I really, really mean that. They do everything wrong. They do nothing right. And it's lather, rinse, repeat. They're the ones that it's kind of like they were in a Tesla and they put their foot on the accelerator and just jumped interest rates up so fast that nobody could keep up with them. And then at some point, they've got to take their foot on the gas, and then all kinds of stuff happens, and it's all bad at the back end. And so where we are now, situation, and this is kind of how it works, at least on a timeline that I'm looking at. First of all, again, Silicon Valley isn't the only one. Silver Lake isn't the only one. There's, you got to put FTX in there too, the crypto Ponzi scheme. There's also something that I'm sure none of you have heard of, and I'll just say it, do it really briefly. Down in San Diego, a few of my friends got taken in, and about like $500 million worth of other investors, I think that's how much it was, got taken in by somebody named Gina Champion, who was seen as this great businesswoman down in San Diego. And you can look that up if you want. But she had a scam where, and this is a true scam, and think about it this way. The whole reason she's able to do this is because you can't get any yield on your money in bonds. She said, hey, people that are applying for liquor licenses, they're hit with this big requirement by the ABC to have all this money in escrow until the liquor, until their application is reviewed and approved and the liquor license changes hands. But a lot of these applicants don't have the money to do that. And so her company magically finds these people and she lends them money, and it's at a really high rate because it doesn't last that long. And these people, once they get their liquor license, they're so happy. The money, and it's all kept in escrow at Chicago Title. One of those guys went to jail too. It's all kept in escrow at Chicago Title, and everybody wins. The liquor license applicant gets their application. Gina's investors in this particular license application had their money totally protected by Chicago Title, and they got something like 15 or 18% on their money, definitely within a year, usually more like 7 or 8 months. It was magic and it was wonderful, right? So some of my friends, a few of them, got, knew this person, and they invested in this, and they were going great. Like one of my buddies tried to talk me into doing it. And I went down and talked with one of the bundlers with the intention of really, really listening. And so I went down, and it actually sounded pretty good to me. Not so good I wanted to put a bunch of money in, but I thought, if Mark and Tom and Larry and Steve, these guys that I know, they're all well-heeled, got plenty of money. If they're saying it's okay, then it must be okay. That was my due diligence, by the way. That was it. Now, I'm not the only guy that would do due diligence like this. There are people that have many more zeros after their net worth than I do that do their due diligence that way too. That was the whole FTX scam. Well, if so-and-so's doing it, if Tom Brady's doing it, then he's got to have done his due diligence. And so I'll get in on that too. And then Brady's looking at somebody else saying the same thing. So for a lot of people, due diligence means, well, if so-and-so's doing it, then I'm sure it must be okay. It's like they subcontract their due diligence out to somebody else. That was me, to Tom and Mark and Steve and Larry. That was it. That's my due diligence. And so I was ready to do that. And I came back to back home, and I was talking to Jennifer about it, my wife, and she once again confirmed that she's a hell of a lot smarter than I am. And her deal was very, very specific and very pithy. I don't understand it. I don't know why anybody would do that. No, it sounds fishy to me. And so I, of course, deferred to my wife, and we didn't do it. Now you can Google Gina Champion and you'll see what happened there. It was a big, massive Ponzi scheme, and she's in jail, as well she should be. In addition to that, then you've got American Car Center that pulled 222 million bond sale. They were trying to sell 22 million in bonds to raise money. They tried to raise it and couldn't, so they went out of business. The point is, all of these little disparate things are these little cockroaches, and some of them are canaries, some of them are canaries eating poison cockroaches. It's just a lot of bad stuff was going on, and so we're finally seeing it now. Now, Yellen says she's monitoring the situation. Okay, this is the same one that like 2 weeks ago, she was in Ukraine, promising basically a blank check to that guy wearing khaki clothes all the time. So he gives the impression that he just got back from the front lines to get this money, and then he's got to get back out there so he can join his soldiers in the latest firefight. I mean, it's one of the biggest scams I've seen in quite some time. If you disagree, that's okay. I'm sure I'm wrong. And so anyway, Yellen's on the case here on this, and so many others are as well. So what's actually happened here? People stopped making deposits at Silicon Valley Bank. So money stops coming in, right? Their bonds are still good, holding their bonds, no big deal. They're fine. And then startups which issue warrants to venture capitalist firms and sometimes even to the bank themselves as collateral for their loans. In other words, you give us a loan. Oh, what's the collateral? Well, you get X% of the company. And they were based on, these warrants were based on promises that venture capitalist firms made for future cash injections into the company. It's like, well, I'm a startup, Danny Startup. What is my collateral? Well, I've got, Vinny, the venture capitalist, who has promised me another 100 million or another 500 million of cash injection into my company over the next year. Can I have a loan? Sure. Yeah, I'll loan based on that collateral. And so promises, though, are made to be broken. And so these rates start going up, business starts going down, and suddenly money becomes more dear. and venture capitalist firms saying, well, you know what, that promises are made to be broken. Am I in breach of contract? Well, maybe, but you know what? That's why there is a paragraph called breach of contract. Sorry. And so then these startups are now cash poor. Okay. Fewer startups now are starting up. Money's not coming in. Money's starting to go out, like a lot of money. The bank assets are okay because they haven't had to sell. They haven't had to put their bonds in the quote for sale column. But at some point, they have to start raising money from their existing assets in order to pay off people who want their money back. And so what do? They have to sell some of these bonds for a 25% haircut. Some of them would be more, some of them would be less. This is just a, one graphic that I took. So they've got to do this. And as soon as they put those bonds for sale, now those bonds have to be priced according to current market value. And when that happens, suddenly the value of the bank's reserves drops below the requirement that the FDIC has for banks. You have to have a certain amount of money or liquid assets in your account in order to continue operations. Guys, they get a whiff of that. Like Peter Thiel just a few days ago, before this thing started. In fact, some would say he's the guy that actually did start it, start the kind of cascade. Hang on, I gotta get my dog. Okay. Anyway, he pulled all his money out, and he pulled out, advised all of his companies, all the investments that he had to do the same thing. And so it was this cascading effect. And remember that term, cascading effect. So it was this cascading effect. And pretty soon it came to a point with Silicon Valley Bank that they were not able to meet their current obligations. They were actually insolvent. And when you're not able to meet, when you don't have the funds on hand to meet your current obligations, what is that? You're bankrupt. And so now it's the weekend, and that's a wonderful thing. Now, the FDIC, I read, is seizing Silicon Valley Bank's branches. They're basically seizing their assets and saying, no, you stop this. You're not going to do anything. We're stepping in at least to stop this. Now, they need to actually fix this in some way, and it's got to be soon, like this weekend, because if they don't, I mean, this is going to be a bloodbath of literally global proportions. SVB has a UK branch. That's an issue. Okay. They got branches everywhere. I just read an article. The United Kingdom and EU lenders lost $30 billion overnight. And, hey, man, I think that's a few payments to Ukraine. But they lost 30 billion overnight. And then this is kind of what panic makes you do. Panic makes you sell, makes you pull your funds out. You're saying like, hey, when I'm feeling really unsafe, I just got to know what's mine. And ultimately that means that companies actually can't even make their payrolls. So there's a real cascading effect that is a real problem for markets on Monday. I think it would be a big mistake to extrapolate this too far and to think that this is like another, environment like we saw in 2007, 2008. It's almost more like when Carl Icahn shorted the securities backed by malls back in 2017. That was really kind of an isolated thing based on poor collateral. And I mean, you look around and malls were ghost towns back then. And so that was a good good short for him. But that was different than, again, the stuff that happened in 2007, 2008. A lot of people don't remember that because they weren't really in, let's say, economically or business-wise conscious back then. You know, what were you doing in 2007, 2008? Were you playing football for the high school team? Were you studying for your exams in college? Were you smoking pot behind the school? Were you in your first job or your second job and the crash didn't really impact you? Okay. I remember that, and the crash definitely did impact me, but here's a frame of reference. Back in 1987, when the market really crashed really fast, I remember I was driving with a buddy in his car and we're listening to it on the radio, and that was a bloodbath. And so we listened to the radio and you know, then we went and got a beer. Why? Because we weren't in the market. It was interesting to us. That's all I remember about it. I don't remember anything else about it. And so we're in this really weird situation where I can look at this and I feel like I have a sense of what's happening and what's going to happen, but that has to start with this statement. Nobody truly knows what's going to happen because we don't know if or what something is going to be done. Something has to be done to kind of deal with this. And I don't know what that's going to be. And because I don't know what that's going to be, I have no idea of really handicapping this. Specialty. And I can tell you this, the market isn't just going to be jittery on Monday. The market's going to be really volatile because people are in a heightened state of alert. People are going to be doing stuff that's going to probably wind up turning out to be dumb. And this is why, see, if you've been listening to me and Lord knows how many other people in, you know, like in the forum or even in other venues who've been saying cash is king. You got to have a lot of cash. Why? For two reasons. First of all, because you avoid the risk of losing a boatload of money if the market tanks. But second of all, you have the cash in order to put to work when everybody else is panicking. Like Warren Buffett has said, you know, be fearful when others are greedy. That was a while ago. Be greedy when others are fearful. That's now or close to now. And so what we need to be doing is looking at things from an objective point of view rather than a subjective point of view. Now, if you have a lot of money that's at risk, it's extremely difficult for you to be objective because you're in it, you're involved. It's a lot of, you know, it's just a lot of stress for you. And I'm sorry about that. But if you're in the right position, you can look at this and say, you know what, maybe I'll just wait until the smoke clears. So let's look at a few things. Okay, back on March 3rd, this was where the sentiment index was. Smart and dumb money, you know, not that far apart. Now, on Friday, it's even 48, 47. So basically nobody has any feelings about anything. All right. This is kind of a lagging indicator because I'll tell you this, it's going to be really different on Monday. Now, this fear and greed index that I've been showing you lately, that I actually got from Dave Ryan, back on February 24th, the first time I showed it to you, the meter was kind of more on greed. People were still, remember, greedy when others are fearful, et cetera, et cetera, et cetera. I hate it when people say et cetera. So then last week, we're at neutral. Okay, so people aren't so greedy anymore. They're like, well, I don't know what's going to happen. And then finally, yesterday, we're at extreme fear. Remember, be greedy when others are fearful. Be fearful when others are greedy. So if we'd been fearful over here, we're about to be able to be greedy over here. All right, so this is a good thing. Now, let's move on. Volatility index, the fear index. it spiked a lot, like almost 10% on Friday. But if you look at where this is historically, this is not a big deal. It's kind of like, I mean, I look at this and it almost kind of doesn't matter. It's really not relevant because there's a lot of inverse ETFs that traders play, so to speak, and that doesn't really impact the volatility index. So this is kind of an old school thing that everybody seems to look at. And I'll look at it too at extremes. This ain't extreme. T2108, that's the McClellan Summation Index. Remember just a week ago, I was saying like, hey, it looks like it's at a point where we could start getting a lift. In fact, if I recall correctly, I said last weekend that I thought the market would probably get a lift this week. And that turned out to be wrong. Okay. A good trader recognizes that he or her, she, it, whatever it is wrong, and you adjust. So I'm adjusting. This is actually what happened. So this fell 34%, 34 flipping percent. This is a condition indicator, though. It's not really a timing indicator. So what we're seeing here is there is still acceleration on volume of declining prices. Stocks are declining at a higher rate and higher volume than they are increasing. And you look at any chart and you can see that. And so if you look at the banking index, you'll see, and this is a weekly chart, you'll see that this just absolutely tanked. This is real damage that's being done, real damage. And so I want to look at some other charts. I know this has been kind of a long monologue for you, but I hope it's been helpful. So let's look, and we'll just kind of take stock of the market charts, and then we'll look at banks and see if we can figure out some stuff to do. You can see that it's had big volume, twice average volume on Friday. Now, this is oversold, but it's not like massively oversold. See, so to look at the major averages and say, oh my gosh, it's a bloodbath, maybe on a volume standpoint, but this only fell on Friday a little over 1%. So that's, it's really not a big deal so far, and probably will continue to be, that we've seen that the carnage is probably going to be limited to, discrete sections of the market, meaning banks. I think they'll all be hit to a certain extent, but the big ones will just recover. In fact, hell, they might even go higher because they can take advantage of the smaller regional banks that are in trouble, certainly with SVB. A buddy of mine who's a big bond trader, I was just talking to him yesterday, and he said this like 3 different times. He goes, God, I hope I can buy Silicon Valley's bond portfolio. He was with Morgan Stanley. He's literally talking about the whole firm. They'd love to just buy it all because they know they're going to be getting it at distressed prices. And so you're going to see these regional banks, and we'll look at the charts in a minute, trading at distressed prices for that very reason. And it's all going to really come because of the psychology of investors. When people fear for the safety of their assets in their bank, they're going to go and take the money out. They're going to go online and they're going to want to pull the money out. Most of you have seen It's a Wonderful Life with Jimmy Stewart. And that's what that whole deal was about, was a run on the bank. That's the type of thing that we're going to be seeing, but it ain't going to affect the business fortunes of Microsoft. So you need, if you're saying, well, this is the big one. No, it may be the big one, but it ain't right now. And I doubt it's going to be on Monday. I think there's going to be some discrete opportunities that you can take advantage of, that I can take advantage of, but to extrapolate this to a global killer is way beyond the pale. But what I'm saying again is, because Silicon Valley Bank is like everywhere. In fact, I'll show you their website. Okay, here they are, the financial partner of the innovation economy. Do you think this is a global thing? This is where all their branches are. Like, they're all over the place. So this isn't just, I've seen some news articles, right? Like, boy, this is really going to devastate Silicon Valley. Well, I'm sure it probably will to a certain extent, but it's really kind of a global thing. And so what I read just a little while ago, again, was the UK and the EU have lost a massive amount of money just because of what happened this last week. So if we look, though, at let's look beyond that for just a second. We've got the S&P that's certainly broken. This is not a buying opportunity. It's not even close to a buying opportunity. This is a chart right here that says you should not go anywhere near this right now. If we look at the small caps, now, when the small caps are doing well and the mid caps are doing well, you know, this is a good sign. When we see the market running higher and we see, oh my gosh, you know, the Russell 2000 still doing okay, that's a good thing. We're fine. But when things get a little dicey, as they are right now, to see the small cap stocks down like they are, that is a big deal. That's a herd of cockroaches. I don't know if cockroaches are in herds. I don't think so. I don't think they're that big. At least I hope not. But so that's really what we're looking at here. The small cap companies, literally by definition, are the ones that don't have a lot of money. And so these are the ones that are going to take it in the shorts, buy the shorts when things get really bad. Now, if we look at the NASDAQ composite, this is another one. Like, this is a key violation of the 50, the 200, the 150-day moving average. This is a lower low. This, a series of higher highs and higher lows. Up, there's a low, but it's okay. It's higher than the last one. Oh, but this is a lower high relative to this one. Well, suddenly this is a lower low here relative to this one. Then we get a little teeny tiny move higher, another one lower, then another one higher, but this turns out to be lower than this one. And then finally, we've got this break there. And now we've got literally seller's delight here. And so I think this is moving lower. How much lower? I don't know. I don't care about that. I just don't think it's moving higher. And I care a lot about that. Now, how about the Qs? The Qs, NASDAQ 100, are still holding, they're still holding tight, holding at the moving averages here. But when you see what the NASDAQ composite did, and you're looking at what Monday is likely to bring, you're going to see more weakness here. But so far, it's holding. Okay, that's the good news. This, not so much. This is the regional banking index. These are the smaller banks. These are the regional banks. These are the ones that traders and investors are going to be looking at with the more jaundiced eye. They're going to be looking at these to see what their balance sheets are like, what's their collateral like, because to a certain extent, I mean, Silicon Valley Bank is a specialty bank, but it's kind of like the market tends to paint with a broad brush. So there's huge volume on this. Look at the typical volume on, I mean, this is the typical volume as it is here. Big sell-off here. Volume, 13 million. Okay, then we move on. Here, volume, almost 100 million. So this is a massive increase in volume, and it's pretty much all selling volume, though we did have a close well off the low. So you can see how this traded. Where this will be on Monday, again, it absolutely depends on what the news is on Sunday night. But everything, think about it this way. everything that you see, um, everything that you see on this chart, okay, this is all like really, really painful, horrible, brutal stuff, like really, really bad, heavy weight. And so any move higher here is going to have to climb through a whole bunch of regret. And I want you to be mindful of this. As stock goes lower and lower and lower, it leaves more pain behind it, and the ceiling just gets lower and lower and lower. And so you're going to see charts where you're seeing a lot of this, and you'll say, well, there's no way this thing's going to get higher anytime soon, anyway soon, and you will be correct in that. But in other areas, in other stocks, that's not the case. So let's look at the big banks that don't have these. These would be the predators. The big banks you could see, like, JP, and we'll look at the others. They sold off hard on Thursday, and on Friday, more downside, but then they started trading up while all of these other regional banks continued to go lower. Why? Because it was a knee-jerk reaction to sell any bank. And then suddenly investors started to be, mindful of the fact that the big banks, they're not hurt by the same stuff that, and certainly JP Morgan isn't, they're not hurt by the same stuff as the smaller banks. And so this could actually be to their advantage. So they were down 10% from last Friday's close. I think, where was that? Here. Yeah, at one point, they were down 10% from last Friday's close. The 150-day held, though I'm not really concerned about that. But then it traded higher. So they were down big time. All of these things were down big over this last week. But Friday, the big banks, for the most part, recovered. Morgan Stanley, by the way, I think I posted it in the forum. I bought a little bit of JP Morgan on Friday morning, only a little bit, just to kind of put my hand in there and see if I could feel smart without losing money. So far, I'm feeling smart, but I ain't making much. So Morgan Stanley, this one took a big dive too. It fell down 9.25% from last Friday, but it just closed 1.6% lower this Friday. In other words, yesterday. I'm doing this on Saturday. So I would look for this to move higher tomorrow or on Monday. Goldman Sachs, this is a key massive break. I don't know what's there's no way I would come close to touching this, but I'll watch it. This is not at all like JP Morgan. So what about Bank of America? Bank of America, it bounced right off of 29, right off of this low here. You're probably going to see a move higher up here as well. And as I say that, I'm mindful of the need to give you again the caveat. I'm doing this when there's nothing being done. I'm doing this video when there's no news of anybody bailing anybody out, but that there are meetings going on, and probably they're trying to drum up some business from the big banks to see who will buy Silicon Valley Bank, and there will be a line for that. Guarantee you that. It's just the price is unknown. So what about Wells Fargo? Okay, this was actually up like JP Morgan, though it was broken, badly broken, but now at least it's looking like this $40 level is going to hold. This was actually up, but it was down 15% from last Friday. And then finally, again, we'll go back to KRE, not doing well at all. So look at these other regional banks. These are the ones that you may be in a position to make a lot of money trading some of these, but you literally have to be sitting at your computer watching the screen. Because if, for example, Pacific West, Pac West, if there's really no problem with this other than guilt by association, you see a 20% move on Monday on this. Once again, I can't tell you what's going to happen on Monday, but you could see this kind of move, but you just really have to be there. You got to watch it. Another one, Western Alliance. Okay. This had a big move, big move lower, and then it climbed up basically out of the abyss. So it's something to watch. And then you can see here, First Republic, again, a big, massive move down, at one point down over half, but then it ultimately closed higher on the day relative to the open. So these charts that I'm showing you, you should be looking at on Monday if you're an active trader at all. If you're not, then you don't care about any of this stuff. Then Signature Bank. And by the way, no matter what happens, it's all good. I mean, things are going to work out. At times like this, it's really easy to get really lathered up and really freaked out about things and like, oh my God, you know, this time's different. It is. Every time's a little bit different, but it's also the same. And if you look back at what happened on every single big world-ending, global killing event, they've all resolved just fine. But each one of them, at least each one that I've lived through, did not feel that way at the time. It did not feel like it was going to resolve. This one felt really different. The market's never going to come back. I'm going to lose all my money. But each time the market comes back, and those that were in a position to capitalize on this carnage did really, really well. People are buying government motors at like $2 or whatever it was. I mean, people are getting ridiculous prices on some companies just because of the panic created by the need to raise money. And so I just want you to know that. I need you to think about it and stay objective. It's going to be fine. By this time next week, I could be doing a whole different thing, you know, singing with maracas. It's just that now we don't know. So anyway, Signature, nasty. Stiefel, bad move here. This took a big dump. At some point, you're going to see a rally here, but I have no clue. Now, one thing that I wanted to mention, ARC Innovation, it only fell a little bit on Friday. Reason I'm pointing this out is, you know, I talked about the types of companies, these startups, these innovative companies that are building, you know, technology that will really be helpful over the next 10 years. This is kind of right up Kathy Wood's alley, where she talks about this. She's a self-proclaimed visionary, and perhaps she is, about all these companies that now kind of don't really make money, but they got great ideas and they're going to be real fantastic in the years to come. Well, a lot of those things right now are going to be on hold because of the situation with Silicon Valley Bank. And by the way, the venture capital world has changed because of this. You're not going to see venture capitalists out there spending money like they were even a week ago. It's going to be different. And so I think this is one that you want to watch. You can watch all of these, all of her funds, her ETFs, to see what's happening. But I don't really think the meat is going to be in the actual funds themselves. I think it's going to be in what their holdings are. I'm sure this isn't a complete holding here, but this is just TC 2000, what they have. So in the ARC Innovation, they've got 26 stocks here. I'm sure there are more. I'm sure there are different on their website. But as I look at this, there's only one that was up. I mean, Tesla was up a little bit on Friday, but only one of note that was up on Friday. And this is kind of right off of a base, but still $3 stock, something to look at, right? Now, if we go on the other side of the coin, we can just look at these stocks that are just busted stocks. And so this would be an area where you would just want to be watching and see if you can find some opportunity, but they would all be short-term opportunities. There's nothing here that I would look at now and say, this is exactly where I want to be. And you're going to see, I'll just kind of wrap this up here. Here's the thing. In our economy right now, in our world, when you can be a first to market, kind of like Tesla was, and that's a good thing. It's like you're first there, you're able to carve out your niche or your niche, whatever, and then everybody else has to play catch up. So you've got a good deal going. That's kind of like how Microsoft was with the operating system, and it took Apple quite a while to catch up to them. So you can do that. And as long as money is free, then there are other companies, though, that can come in and say, hey, I think I've got a better idea. I can compete. And then they typically can. And you've seen that, like with Tesla, it's a different deal because Tesla, I think Musk is a genius. I've gone from I've hated him, I've despised him, I've loved him all across the board. I just think the guy is a true innovator, and I absolutely respect him. Who wouldn't? Only a fool would say, I don't respect Musk. Really? Okay, get out of here. I don't want to talk to you. But aside from Tesla, where they led the industry, they're still the leader. Their car quality ain't that good, but the technology is the best, and their charging stations are all over the place. You're not going to get that with the Leaf or whatever it is. So anyway, if you look at other industry or other industries of innovation, think about this: Zoom, Skype, Google Meet, GoToMeeting, WebEx, Microsoft Teams, Discord, TeamViewer, which I'd never heard of, and all these other companies that are really competing in the same space. Okay. They all need money. And so if this venture capitalist environment really suffers to where all this money is no longer all this money, it's only a little teeny tiny bit of money, all this innovation is really going to stop. Now, do we want that to happen? No, I think competition is good. How can we ensure that it will happen? Well, we can try to actually increase the liquidity in the market so that companies will, venture capitalist firms will be lending and investing in startup companies. And how can we do that? Well, let's say one big ass pivot by the Fed. That's what I think anyway. Okay, let me show you a couple stocks that are really wild. So Meta, I wouldn't buy this on Monday, but it is telling that this thing is holding above its moving averages. It's in a little squeeze here. All this stuff that happened, it didn't even blink. This is a stock you definitely want to watch. I would say set an alert at 190. That's what I'll do. There you go. Set an alert at 190. And if the stock breaks out above there, acknowledging the fact that breakouts kind of tend to have not been working. With that said, if the stock breaks out here, it could be moving higher. So what's one stock that seemed to be bulletproof? Twinkies. All right. And I guess, if I was in the VC industry, I would be feeling like I'm eating Twinkies too, a lot of them. But if you look at this thing was a stellar performer on Friday. Definitely want to watch that. I will set a price alert. This is just for me. I will set a price alert right here. If this stock breaks out above there, and it sure looks like it's gonna, we could see a nice move to the upside. And then one more, and then I'm out of here. C.H. Robinson, trucker. This is not a volatility squeeze. It's a really, really choppy chart, but it is noteworthy, I should say. It came up on one of my value scans, actually. It's noteworthy that this stock opened higher on Friday and then closed essentially at not essentially, it closed at the high of the day. And so these are stocks that you can be looking at. There's a bunch more out there, and I know we'll be looking at them in the forum on Monday. But this is really kind of all I have to say about that, to quote Forrest Gump. So I hope this session has been good for you. I apologize for the length, but now you've got my view as far as where we sit right now. And I'll just make this suggestion to you. Don't be dogmatic. Don't approach this next week with a very, very firm, strong opinion that you're confident in. And by God, if the market doesn't conform to it, you're going to stick with it because the market's wrong. Don't do that. And this is what I mean. If you think the market's going to bounce and it doesn't, there's a reason for that. And the reason for that is that forces that are much more powerful than you or me are pushing stocks lower. And those forces know more than you or I do. They know a lot more than you and I do. So we have to give way to the will of those big, powerful forces. On the other hand, if you think that this is a global killer, it's not. But if you think this is it, things are going to zero, I got to get out, I got to sell all my stuff, and then the market starts moving the other way, don't wait for people to regain their senses and come around to your point of view. Don't do that, because again, those market forces are disagreeing with you, and it never pays to disagree with the market forces. You want to stay in sync with them. And I will tell you this too, just the last thing. Let's say you're in stuff, you got kind of caught off guard. And so you've got, I remember saying this on Friday, that, hey, this is a bad week. I don't see anybody stepping in towards the end of the day so they can take big positions and then fret about them all weekend long. But let's say you have positions that you've been fretting about all weekend long and you're really underwater on them, and they open up even lower on Monday. If you choose to sell them, also choose to watch them, because it could very well be, if you're feeling really emotional about something and you say, well, I just got to sell, you're not alone. You are not alone. There are going to be a lot of traders, a lot of investors that are doing the very same thing, because we're all hardwired the very same way. So if you have hit your ultimate pain threshold on some silly stock that you have, and you're saying, this has gone way below where I should have sold it, I didn't honor my stop, or maybe I didn't have a stop, but I got to get out of this stock. Okay, fine. Punch out if that's what you want to do, but watch it, because it could very well be that as soon as you sell, soon as all your buddies, none of whom you know, but they're all doing the same thing, as soon as everybody is sold, that was the bottom, and that's when the stock's going higher. It happens. It happens a lot. It's happened to me. And that's why I have this 1% rule. If you sell because you're freaking out, watch the stock. If it goes back 1% above where you sold, buy half of it back. If it goes up another 1% from where you sold, buy the other half of it back and put your new stop just below your first purchase. That way you're able to get back in with a very, very minimal risk. By the way, this is not a trading strategy. I've had people say, your trading strategy doesn't work. And they explained it to me, and I'm looking at the charts that they were using it on, and I'm going like, this doesn't even apply. It's like, what are you doing here? So I'm talking about in an extreme situation for you, not for the market, but for you. If you're freaking out about something, use the 1% rule to go ahead and get out, feel better about yourself. But then look at this. And if you say, crap, I think I sold right at the bottom, well, get back in. It's all good. Okay. That's all I got for you. I will see you Monday morning. I hope you have an awesome weekend. I know I will. And let's go get them next week.